Hello and welcome to this special monetary policy show. The minutes of the last monetary policy meeting on August 6th, when status quo was maintained, have been just released. The consensus among all members is that wait and watch is better. The minutes appear to show some difference of opinion on growth, while the governor and deputy governor, as well as the RBI members, are somewhat confident of growth. Some of the panel members, especially external member Nagesh Kumar, appears to be a little more worried about growth, given the current trade scenario and likelihood of much higher tariffs from the US. But all the members have more or less agreed that some firepower needs to be retained by the Reserve Bank, considering the prevailing uncertainty, considering the several moving patterns. To take this discussion forward, I'm now joined by Mr. Nagesh Kumar, the external member of the RBI MPC. Mr. Kumar, thank you very much for joining us on the show today. Sir, you are an expert in international trade, and you have indicated that you are quite worried about the way in which the trade between India and the US is progressing and the likelihood of high penalties. At the moment, you are, of course, wiser than what all of us knew on August 6th. What is your assessment? Do you think now the blow to growth looks a little higher?
Certainly, the Trump tariffs and also the 25% penalty kind of penal tariffs, which have been talked about. And one has to see whether we can have them waived, because there are discussions currently, as we see, happening between President Trump and European leaders to see the war, Ukraine war, coming to a stop. And if that happens, the rationale for imposing those tariffs, penal tariffs on India, would be gone. So we have to see that. But in any event, I think 25% tariffs, which were imposed earlier on India, and especially in the context of the fact that US is the most important market for India, and especially for the labor-intensive goods, it would certainly hit the Indian economy, the manufacturing sector, in particular the labor-intensive sectors, which provide a lot of jobs. So there will be impact. But, we need to take action to minimize that impact and, move on. So there are some estimates which suggest that there could be 20 to 30 basis point kind of, effect on our current year's growth.
That is assuming 25% tariff. It is a 0.3 percentage point of the GDP likely to get impacted. Is that right?
Very preliminary, back of the envelope kind of calculations, and nobody has really come up with very serious general equilibrium type of estimate.
I agree. But what you are referring to is the 25%. If it is 50%, the hit would be more.
Yeah, obviously.
Fair enough, sir. I'll just come back to the trade and the growth bit in a minute. But I also wanted to ask you, since you are an expert on international trade, how are you seeing the disinflationary or inflationary impact, since everybody is going to be handicapped in terms of their exports to the US? And even today, we are seeing commodity prices receding, especially crude, but not only crude. So do you think the disinflation that you're seeing in the country can be even more than what the Reserve Bank has forecast?
I think on inflation side, we can expect a kind of a downside risk, and also because all of these actions that are being taken in the United States are likely to hurt United States economy, and the prices are going to go up there because of the impact of tariffs. And if that happens, the growth, rate of United States will be affected, and that would also depress the global commodity prices. So there will be a kind of several, a very complex kind of
Yes.
impact on global commodity prices.
Yeah, that is another general equilibrium analysis we have to do.
That's right.
Because of the many-sided impact that we can have. The third factor that is different from what you didn't know on August 6th is the GST cuts that look imminent by the time we come to the second half of the year. Will that have a further pressure on inflation and therefore give the MPC more elbow room to cut, you think?
Definitely think that there will be effect of the GST cuts, on especially on the items of mass consumption. And if the GST rates are cut, obviously it will bring down prices. And that, as you said rightly, inflation remaining in the range-bound manner releases some policy space. So, but one has to wait and see what kind of impact that is, and then accordingly, act on those numbers.
Okay. So, there are some people who are extremely despondent about growth because of this threat of 50%, which now maybe will prevail at least for some weeks. It doesn't look like we're going to escape on August 27th itself. Given that, as well as, other factors, there are people who are a little more pessimistic about growth in the second half, not in the first half of the year. Do you think there is more than 25 basis point space to cut or requirement to cut? One, because inflation is likely to be lower than even what the RBI thought because of GST and Asian disinflation. And two, because growth may be hit more than we thought.
I mean, this is what we discussed, and we thought, let the data come. And so it was too early to say that growth will be hit by how much and inflation will be remaining in restrained manner. And so we thought we need to pause for this moment and let the data come in, and that shows the way.
Okay. When you read the data, when you read the minutes, it does look like the RBI members seem to be a little more confident of growth versus the external members. Was there such, a sense you got during the discussion as well? Y'all seem more worried. Clearly, you seem.
Because I, work on industry and manufacturing sector, I have been a bit concerned about the fact that private investment is not picking up the momentum. And of course, currently, you can't blame the private sector because the trade policy uncertainty is definitely an issue, a challenge. So I'm a bit concerned about growth and manufacturing sector. And that is, what is reflected in my statement.
Okay. So was there, during the discussion, a feeling or an argument which any of you made that giving the rate cut in August would be better so that the festival demand will pick up? If you gave the rate cut on September 30th, then probably a little bit of the festival season, at least Dussehra is over, or much of the Dussehra shopping would be over. Was not that a factor that give it earlier rather than later?
The point is that we have already cut the repo rate by 100 basis points.
Yes.
And the transmission happens with a lag. So even the existing action has not been fully transmitted. So there is this, cut which is yet to be going to the market, so to say. And so I expect that this ongoing process, and especially because the liquidity remains in surplus, I hope and I'm sure everyone is looking at the further transmission of the existing actions taken by
Yeah.
RBI in the last three rounds.
Yes, absolutely. 100 basis points and 100 basis points CRR cut is fairly significant. So, the number that we will get on August 31st for the first quarter are likely to be good because there was advance buying ahead of the tariffs and there is almost negative WPI for a couple of months. So the deflator also will be very low. But the industry, the sense I get from industry is that they're terribly worried about the second half. Would you share that, sir? Are we in danger of a 6% or a sub 6% at some point in the second half simply because the world is looking very nasty?
Definitely, there is a concern, but I remain optimistic that we can make it to 6.5% or thereabout, because government is taking action on export front. The package for export diversification is being worked out. The stimulation of private investments is also being thought about. The demand also will be stimulated by capex of the government. So overall, my feeling is that we will close the year with closer to 6.5% plus minus.
A very quick last question, simply because you are the trade and industry expert. Do you think a specific subsidy is called for those exporters who are going to be hit? The textile exporters, leather exporters, jewelry exporters, shrimp exporters, extremely labor intensive. A specific, government giving them that 25% penal tariff. You think that's called for?
Completely some kind of hand-holding and, giving them the confidence that we are with you in this hour, while negotiating with the trade partners a better deal, and also, the working out how we can, exploit some of the domestic demand, which is currently met by imports, and also using or exploiting or harnessing the potential of some other trade agreements that India has concluded in the past, like Japan, Korea, UAE, Australia, UK in the very recent time, and working to expedite the negotiations with EU on the pending FTA. So all of these actions and some hand-holding would be very helpful.
Okay. Yeah, actually, you have summarized that very well in your minutes itself. Mr. Nagesh Kumar, thank you very much for joining us with a comprehensive view of what we may be in for in the remaining months of the fiscal. Thank you very much for joining us. We have to take a very quick break, but thereafter we're going to be joined by some industry experts to tell us what they have made of the minutes of the RBI MPC meeting. Welcome back to our special broadcast on the minutes of the Monetary Policy Committee. The committee meeting, of course, was on August 6th, 4th to 6th, but what we now get are the minutes. We just heard Nagesh Kumar, the external member of the MPC. I'm now joined by Abhishek Upadhyay, senior economist at ICICI, and Suvodeep, Rakshit, the chief economist at Kotak Institutional Equities. Gentlemen, thank you very much indeed for your time. Abhishek, let me get directly to the heart of the issue. Did the reading of the minutes give you the sense that October is very live? September 30th is very live for a rate cut?
So that was the focus after the dovish pause, which markets anticipated. It was a hawkish pause. I think besides the timing, there was also some emphasis on whether there is scope for any additional cuts at all or not. For both these aspects, whether scope for additional easing is there or not, and October rate cut, there is no big clarity from the minutes. particularly if you are reading the comments from RBI leadership. Yes, an outgoing RBI member has indicated it was a closer call, this policy meeting, and the bias is really to preserve some policy space to act in case downside risk to growth crystallize. And that is prudent, but otherwise no clear hint per se that any rate cut is imminent. There is continued focus on medium-term inflation prospects. Arguments broadly indicate members feel growth is still resilient. And there is an additional point being made that totality of RBI actions need to be seen both in terms of rate cuts and liquidity easing measures. So it is likely that RBI is going to be more reactive to any bout of growth weakness, which we do think is a reasonably high probability scenario, rather than being preemptive and taking measures to curb downside risk to growth.
Tomorrow, when the bond markets open, you don't see this as a hawkish pause being converted into a dovish pause. You don't see bond prices inching up at all?
So if you're looking at the swap markets, roughly about 50% probability of a rate cut in October meeting is what is priced in, and nothing thereafter, which I think is a reasonably low probability broadly in terms of rate cut expectations. So I don't see this, these minutes to give any additional information to markets in terms of rate outlook.
Okay. Yeah. Okay. So we remain at around 6.5. Suvodeep, what would be your key takeaway? Are you getting a sense that you can detect some more dovishness than we heard at the conference?
I think so. I would not say it is dovishness per se, but a willingness to keep the door open. I think that is my takeaway from the minutes, that they are willing to keep that door open, look at the tariff impact, and not just the impact, but also what the outcome is of the tariff. Keep in mind that what the growth impulses are, and then remain data dependent. I think it's important to note that almost everyone has mentioned that they want to be data dependent. Yep. So the room for rate cuts is there, as some of the members have mentioned. But at the same time, I think they are not committing to any kind of rate cut stand or any kind of rate cut to be built in as of now.
Okay. So basically, the key takeaway is that MPC members as a whole have kept the door ajar for a possible rate cut, but not committing to any. Now, Suvodeep, a lot of water has flowed under the bridge from August 6th to today. Chances are that the 50% tariffs are going to stay for some time. It doesn't look like that they're going away on August 27th itself. It may be for a few weeks only, but it looks like we're going to be faced with that. Do you think that from then to now, the growth picture has gotten worse and therefore the chances of an October cut are higher? I'm not discussing minutes now, I'm discussing the macroeconomy.
Sure. So a couple of things have happened. One is, if you look at the tariff side of things, the tariff part has gotten worse in the sense that we now know that there is a penal rate which can come sometime towards the end of August, and we will have clarity on that. But even with the 25%, I think there's a 30-40 basis point impact, negative impact that we can see from base case of, let's say, 6.5%. We were at 6.2%, factoring in some impact of the tariff. We continue to remain at that. However, if it's a 50 basis point, I think it becomes a much more serious issue in terms of much more higher impact. The entire 55 billion odd of exports comes at risk. Along with that, I think important part to note is that there will be impact on the labor market too. These are all export-related numbers that we are talking about, a direct impact, not necessarily a more so-called general equilibrium impact that we talk about. This is more on the labor market. There could be an impact. The second part is that the GST rate rationalization has already been done. We'll have a fair sense of, by the end of September at least, we'll have a fair sense where we are headed. We might or might not know about what the rates are, but we'll have a fair sense of how much of an impact could be coming in. And I think the RBI would look into these two aspects and kind of take a call whether the growth impulses are weakening further from what their August policy meet indicated.
Okay. A similar question to you, Abhishek. Are you getting a sense that the macros have worsened since August 6th? especially on the tariff front. And therefore, the Reserve Bank, if it were writing its minutes now, would have been more dovish. Are the chances of a cut, therefore, higher on September 30th?
Agree to that, Latha. So if we are talking in quantitative terms, if 50% tariffs hit and then stick for some time, then we think the annualized growth impact of that could be almost 1% in GDP terms. On the contrary, on the flip side, we've had this GST. We will likely have GST rates edging lower. On the benefit of that could be half the negative impact of tariffs. So about 0.5% or so. So overall, adding these two drivers, we do think downside risk to growth have increased since the last monetary policy meeting. At the same time, from RBI standpoint, they will like to see whether these tariffs are going to stay for a reasonably long period of time or not. Also, they would likely, after having front-loaded so much easing, they should likely wait for more clarity on how government is likely to react to these build-up of risk by way of fiscal policy easing measures. Therefore, in that context, I would think the probability of rate cut in October is still quite low. But I do think RBI could act a little more forcefully once it is reasonably clear that downside risk to growth are material looking ahead.
So you're saying that December or February, the chances are brighter for a cut than September?
Yes, based on information we have currently.
Okay. Suvodeep, what's your policy expectation?
Similar expectations. I do not attach let's say, a more than 50% chance on a rate cut in October. But I think the growth impulses are quite weak if we start factoring in the tariff impact. And from that perspective, the room for rate cuts remain. However, if you look at the August policy, the bar for cutting rates have been raised higher. Okay. And to that extent, we have to take into account the fact that FY27 inflation is not looking favorable, at least from RBI's perspective, and it has to balance out the growth impulses, which may not necessarily show.
So you're saying not bright chances of another cut. Is that your point? Okay.
Yeah.
Very quickly, just give me a monosyllabic answer, both of you. Where do you all see the 10-year for the 10-year bond yield for the remaining part of the year? Abhishek?
It's at 6.5 currently. I think it settles down here for a bit, but then the direction of travel is clearly higher, assuming we are at the end of rate cut cycle.
Okay. Suvodeep?
A similar 650 is where I would place it in the near term, but I think once the chances of the rate cuts are taken away, it starts moving higher.
Okay. Thank you very much, gentlemen, for packing in so much in a very short time. The key takeaway for our experts is that although the Reserve Bank minutes are indicating a wait-and-watch attitude, the chances are that the Reserve Bank may wait it out even in the September policy and go forward and maybe take some action if growth is genuinely hurt. Take the action in the December or in the February policy. Also, their expectation is that bond markets have really nothing much to react to. The set of minutes, they are pretty much what we got from the press conference on August 6th. That's it on this edition of our special coverage on the MPC Minutes. Thanks for watching. There's more news and updates lined up for you after this break.